All right, Willem Buiter joins us now. Mr. Buiter, good morning. Thank you for joining us.
Pleasure.
Is it fair to say that in the near term, the world should be worried about not how emerging markets or countries like India and China would react where tariffs have been imposed? The problem actually in the near term is about US because they will have to deal with higher cost of capital and a potential threat of inflation going higher because of additional tariffs. Mr. Buiter.
Well, I think both sides stand to lose. And emerging markets like India that are threatened in the Indian case is a 26% tariff would clearly be adversely affected by this. It is true that the US is not going to be a net beneficiary from a tariff war. The only way that it could benefit from it, if it is not a permanent increase in tariffs, but a temporary increase or a threat of an increase, which is meant as a negotiating tool to lower tariffs and other trade barriers in the rest of the world. So unfortunately, the US also sees tariffs as a source of revenue, tax revenue in a way. And that, of course, only will be there if the higher tariffs are permanent. So I hope that the tax revenue argument for tariffs does not dominate, and that this is just the first in a continuing sequence, a bit random, of bids and offers for lower tariffs for the rest of the world on imports from the US.
Sure. We've got Hugh Johnson as well joining in. Mr. Buiter, just stay with us. Hugh, hi, good morning, and thanks for staying up for us. Wanted to understand that, while most equity markets are seeing a knee-jerk reaction and trying to calculate as to what the tariff implementation would mean, you think the bigger challenge is for US because they're going to be hard hit by inflation, growth is going to get a challenge, and, the internalization of economy is going to take a very long time as well.
Well, I think everything's going to take a long time as this works out. I think I got a pretty good idea what the sequence is going to be. The U.S. is clearly going to be affected, and that shows up in the consensus, the changes in the consensus forecast for the U.S. economy, as well as the changes in the Federal Reserve's forecast. And just as you said, the U.S. economy is not going to do as well as we thought a month ago, and that's the Fed saying that. That's also a consensus saying that. So the U.S. economy is going to suffer. We're not going to have as much growth, and we're certainly going to have higher rates of inflation in response to rates of inflation moving a little bit higher over the next, say, 7 or 8 months in the U.S. You're likely to see the Federal Reserve respond either by leaving rates unchanged. They're not going to lower rates. And the second thing is they might even increase rates. That's number one. In response to the Federal Reserve, you'll likely see long-term rates go up. You'll see stock prices come down, and that's what we're going to have develop over the so-called first stage of this trade war. Every other country is going to be affected as well. When you're talking about higher tariffs, obviously that's effectively a tax on those countries. They're going to certainly be they'll certainly be suffering, but not as much as the U.S., which is the focal point of everything that's going on. That's just the first stage. We could talk about the second stage, which will be much better than the first stage. First stage is going to be difficult. That's what we're going to start to go through right now.
So let's talk about, Hugh, the second stage and what you predict that would be, and also your thoughts on which way the dollar is going to move. Of course, overnight one is only seeing a knee-jerk reaction, but do you think the dollar dominance is going to cave in post the tariff implementation on the world?
Yeah, it very well could be, but the first stage, remember, is we're going to have inflation going up. The Federal Reserve may be tightening policy, maybe leaving it unchanged, not reducing rates. Long rates going up and stock prices going down. In the second stage, and now that's about, let's say, 3/4 of a year, maybe a little bit longer away, what we'll have is a response to what the Federal Reserve does in this so-called first stage. And in that stage, you're going to see, first of all, you'll see the economy react. The economy will slow down, particularly the trade numbers for the U.S. The trade numbers for the whole globe will not be good. We won't see very good export prices, export conditions. We won't see good import conditions. Under those conditions, you'll start to see the not only the economy slow, but interest rates will, longer term interest rates will come down. And in the second stage, that's when you start to see the stock market start to recover. In the first stage of the last trade war that we had, the stock market was down about 7%. In the second stage, when the economy was slowing and interest rates were coming down, the stock market went up, hold your breath for this one, 26%. So first stage is a tough stage for investors. Second stage is a good stage for investors. And I think, well, right now, unfortunately, we're in the early stages, early first stage, and we're going to have to wait for the second stage.
Mr. Buiter, what to your mind is the possibility that it's not going to be a slowdown for US, it could be a recession? Because the whole thought that recession could come and hit US economy in the second half, that conversation has already started.
It is already started, and it started for good reason. And the principal focus of, quite frankly, that argument or discussion is on consumer spending. If we look at the consumer spending numbers, they've been coming down little by little, third quarter, fourth quarter, and also in the current quarter, where we start to see the retail sales numbers and personal consumption expenditure numbers coming down. First quarter looks like we're going to have 2.8% or so consumer spending growth versus the kind of numbers we've been looking at, 4%. So you bet it's going to be a close call as far as a recession. Right now, as I see it, I don't think we're going to have a recession. Slow growth in the U.S., yes, it's slowing. Consumer spending is going to be slowing. First quarter, second quarter, third quarter. But I think we're going to miss a recession. Now, I say that with my fingers crossed. Nobody knows for sure, but there's no question that we're talking about a recession more and more every day, particularly with every number that we look at, particularly those consumer numbers.
Okay. I'm just going to mark the Indian index, and then I'm coming right back to Mr. Buiter, which is that the recovery from the lows, at least for SGX and for Chinese markets, is quite commendable. Imagine the tariffs are at play. Countries like India, China, Vietnam, Bangladesh, that's where the impact would be. But, financial markets, they are a completely different kettle of fish. I mean, I always say that buy the rumor, sell the news. Well, in this case, you could have a situation of sell the rumor and buy the news. Mr. Buiter, my next question is that while we are talking about a big slowdown in America, that means in the near term, bond yields will go down. That means in the near term, commodity prices will go down. That means in the near term, dollar index will go down. Is that indirectly good news for emerging markets and especially financial markets? Because a weak dollar, drop in yields, all that has historically augured well for flows back into emerging markets. Mr. Buiter.
No, a weak dollar, if it means strengthening exchange rate for emerging markets, is hardly good news for exporters in emerging markets, right? So I would not say that this is an ambiguous good news for emerging markets. I do believe that the slowdown that we are likely to see in the US, I also don't anticipate a full-scale recession, negative GDP growth, but I can see, as we move into the second half of the year, lower GDP growth and a slight uptick in inflation, that is not really, I think, a good news for emerging markets. If the largest economy in the world slows down and reduces its demand for the exports from emerging markets, as Trump's policies would if they are implemented, this is not good news for emerging markets.
Okay, let's get a final word from Mr. Johnson. And Mr. Johnson, if you have to invest in one asset class right now, given that there is a genuine fear of slowdown in the world, would you go for gold, which is safety, or would you go for Bitcoin, which is growth?
You can own a little bit of gold, but quite frankly, that's not in my DNA. My DNA says if you're going to own equities, and I'm not sure I would really change my asset allocation, I'd probably preserve or keep a meaningful allocation to equities. Maybe you want to reduce it some. And if you reduce your allocation to equities, in the equity component of your portfolio, you want to have what's traditionally called the defensive sectors of the market should be overweighted. Utilities, consumers, staples, healthcare, and maybe some real estate. So, I mean, be a little bit on the defensive side for now. It's still too soon to go all in or to become bullish again. That's the second stage. We'll see that coming, but unfortunately, you're going to have to wait a while before we have all the signs that tell us that we're headed towards that second stage. And keep in mind, it takes time to get to the second stage, but when you get there, investors are going to be happy. My favorite expression when it comes to the financial market, and it certainly prevails right now, is that it's time, it's not timing. That's the secret to success in the market. So I'm advocating a great deal of patience and a recognition that it's going to take time to get to the second stage and to the recovery in the financial markets. It's going to get there. We're going to get there, but it's going to take time before we get there. Unfortunately, we're still just at the beginning of the first stage of this trade war.
Oh, yes, absolutely. It's always been time in the market or not timing the market, which really succeeds in investing. But Hugh as well as William, both of you, thank you so much for your time this morning, and glad you could make it.
If you like this video, then like, share and subscribe to ET Now.